This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome to the Fintech Takes podcast. My name is Alex Johnson, and I am delighted to bring a special guest edition of the Fintech Takes podcast to your ears. My guest today is James Wester. James is the co-head of payments research at Javelin Strategy and Research, where I think you've been for the last, 2.5, 3 years?
3 years,
James?
almost, yeah.
Okay, all right. And prior to Javelin, James was the Director of Strategic Communications, very fun job title, for blockchain, crypto, and digital currencies at PayPal, which is highly relevant to the conversation that we're going to be having today. And before that, spent a very long time at IDC as a market research analyst, which actually is, I think, where you and I first met, and certainly where I first became aware of your work. James is one of the people in this industry who I got to learn from when I was first getting into the space, and have been an avid reader and student of your research for a long time, James. So delighted to have you on the podcast. Thank you.
I am delighted you're delighted. You know, as an analyst, you are not often greeted with delight. Sometimes you're the guy that comes into the room and says, yeah, that's not going to work. So I'm happy that there is some delight here.
Well, there absolutely is. Might have something to do with the fact that I'm not responsible for actually building anything or doing anything. So I just get to have fun conversations that are highly theoretical. But I have a good one for us today. You and I have exchanged quite a few notes and messages on Twitter, email, a few conversations, a few drinks in person over the years. And I always find you to be a very fair, but also very open-minded student of everything that's happening in the space. As I alluded to before, you've spent an increasingly large amount of time more recently in your career focused on blockchain, crypto, digital currencies, but obviously with a very deep grounding in payments and sort of the larger financial services industry as well. And the reason that we wanted to do a podcast version of the conversations we've been having is you and I have sort of been anchored on the same question recently, which is around stablecoins. So as I'm sure folks listening have seen, stablecoins have become, I think, one of the sort of hottest areas, not just in crypto, but really in like financial technology broadly. This, I think, kind of started in earnest from my perspective when Stripe announced it was acquiring Bridge. But realistically, it started well before that, including most notably when PayPal launched its own stablecoin. And as the sort of stablecoin mania has built slowly and then sort of reached a bit of a fever pitch lately, what I've observed is that everyone is trying to sort of figure out and work through, well, where can stablecoins provide the most value? What use cases can we plug them into, right? They're theoretically very interesting, but what can they actually do, and where can they be a sort of lift on top of the existing infrastructure that we have? And I think like international payments and remittances and cross-border payments has been a pretty obvious area of focus.
Yep.
But one of the ones I've seen some people talk about, and quite frankly, the folks I've seen for the most part talk about it in a very surface level, kind of truly annoying way because they don't really wrestle with the details of it, is can stablecoins displace incumbent payment rails? So think cards, ACH, that type of stuff for domestic consumer payments use cases. And the context here, which we all know, I think if you spend any time in payments, is that merchants constantly bitch about paying interchange fees. If you're large enough, like a Walmart or an Amazon, you make it sort of your mission to destroy Visa and MasterCard. That's how much you hate paying that 2 to 3%. If you're a smaller merchant, it might not be at the top of your list, but it's certainly something that you're annoyed by. I think we've all seen the signs at different small merchants that say, we'll have to tack on a surcharge if you're going to use a card, that kind of thing. So it is a pain point that exists for a lot of merchants. However, absent all of the other things that cards do for consumers and for merchants, you can't just say, hey, we're going to take a cheaper payment rail and swap it in for cards, and we're going to sort of replace everything that cards were doing. Like, it's not an apples to apples comparison if you frame it that way. In addition, and James, I know you've paid a lot of attention to this as well, ACH exists and has existed for a long time. It's a very robust, very well-tested payment rail, which just from a money movement perspective is quite cheap. Now, it doesn't have all of the infrastructure and rewards and other things built into it that enable it really well for some of these use cases. But as we've seen recently with open banking and with 1033, there is this sort of resurgent interest in pay by bank as an alternative rail for domestic consumer payment use cases. One of the benefits of which being it can potentially be a little bit cheaper in a true apples to apples comparison. So, Mr. Wester, I put it to you because I know you've spent a lot of time thinking about this. What do you think are the odds or the potential of stablecoins to actually play a role for this particular use case?
Good question. And really good intro there, by the way. I do want to just call out one thing that I think is super important. And I think you hit the nail on the head. And that was that stablecoins really hit what I would call the zeitgeist in payments when Stripe spent $1.1 billion on Bridge. Yeah. That was the point where even the skeptics, and I am the first person to say, skepticism is not only necessary, it's healthy in all payment tech and in all fintech. Mm-hmm. But even the skeptics of crypto, digital asset, Bitcoin, whatever fits under that large umbrella, the moment that a company like Stripe, which is incredibly well respected in payments, has done some really great stuff, goes out there and spends $1.1 billion on a stablecoin company like Bridge, that's where everybody, even on the most skeptical side, had to step back and say, okay, maybe there's something here after all. Didn't erase all skepticism, but it did say maybe there's a there there. And that's the question I think you're asking is there a there there? And I'm going to stop saying there because I think we all know where I'm going. And that is, yes, there is actually something that I do think will work within payments largely. Mm-hmm. And I think you hit the one that everybody has talked about the most, which is cross-border. Yep. Because cross-border is most expensive, slowest, most broken, worst user experience, lots of issues, especially when you're talking about remittances back to emerging markets, options, all of that stuff. So we'll set that to the side and go with, what about in the US, domestic retail? And the answer there is yes. Is it going to replace things? I'm never a big believer in really anything being replaced in terms of payments.
We still write checks, man. Like that's fair. That's a fair critique.
I mean, we still use checks. And there are still applications for checks. And people talk about, I hear that all the time, especially from my European friends who say, why do Americans still use checks? And it's, well, checks still work. They have some use cases that cannot be beaten, at least right now. So is it going to replace them? No, but are there going to be some applications? Yes. And we've had a conversation about, a good example to me would be, let's say that you have a large purveyor of coffee that has a very strong brand. I'm not going to do that. Let's just say it's Starbucks. But you take somebody like Starbucks who has, I think, something like $15 billion or something sold in prepaid, has a great brand, has a great application and user experience. There are some weird things about prepaid and gift cards in terms of an accounting treatment. They have to be treated as a liability, not an asset. There are things like breakage. Let's say that instead of doing that, you issued a stablecoin. We will call it a Starbuck because that's, of course, the obvious branding there. And instead of me reloading that prepaid, let's say I bought a Starbuck stablecoin. That's now a stablecoin that from a user experience, I'm not going to know really any difference. And I do think that that's a really important part of all of this discussion. It's one of the things we have learned about, and we're learning about even like pay by bank, is consumers don't really care what's under the covers. They just want to know that some payment has been made. So if you were to issue a stable coin, and now Starbucks has that large amount of money that, and again, this would all have to be within, it would have to be done in a very certain way, very carefully, very transparently. But now you have all of this money in a stable coin that you're holding. It's being held, let's say there's a $1-for-$1 to Starbuck exchange, that it's very liquid and you can move things in and out. What that would do for a Starbucks is allow them now, instead of looking at it as a liability, it's an asset. It would potentially allow them to expand that ecosystem so that instead of me just using it at Starbucks, maybe I could use it somewhere else. Maybe that Starbucks would be good for, you could think about what kind of use cases or applications a Starbucks would want. So if it's a de facto office for many people. So if you wanted for a small business, would they be able to use a Starbucks somewhere online? And so long as the merchant partner who's part of that ecosystem would know that Starbucks is exchangeable one for one for $1, why wouldn't they take that? Especially if they know that they're going to save on, as you mentioned in your intro, save on that merchant fee. They don't have to pay it. They can just accept it and they can move those things around freely. That's the type of retail use case I think you're going to see. Another one after our last discussion was, and I used to always have this formula in my head when I would look at new payments, and it was usability, utility, and user experience is something very, very usable or ubiquity, usability, and utility is something ubiquitous. Can you use it lots of places? Utility, does it solve a problem that's not solved somewhere else? And the user experience, is it something that a consumer can use or a merchant can accept and there's no problem? So long as you can do that within an ecosystem, that means that your payment mechanism, the new payment mechanism, will probably be adopted. So one of the things I was thinking about is, somewhere like a Walt Disney World, you have that brand again. You have within the park the need to maybe create money that you could move back and forth cheaply because you're going to have people making multiple purchases throughout the day. User experience better than anyone because you're Disney and you know how to do that. And if you've ever been to a Disney property, you know how incredibly well they make that stuff work. So that would be another one of those examples of where, Disney has their Disney buck, their Mickey buck, and you could maybe spend that. It's an expensive trip. Maybe somebody would go out there and put it into an account. They have those. They can divvy it up amongst their kids. It could be used on a mobile application. And by the way, I don't know if Disney is doing something like this. I give it to them freely if they would like to. That would be great. Invite me to a park. I will try it. But that's the kind of thing where it would be ubiquitous within the park. The utility would be, you don't necessarily have to have cash. You don't have to have a card. It would be useful across the entire property, which is massive. And the user experience could be made better. That's the type of place where I see stablecoins having a fit, not necessarily replacing anything, but finding that fit in an ecosystem. And that's actually kind of what PayPal was trying to do too. They own that consumer, they own that merchant, they have that ecosystem of merchants and consumers, a large number on both sides. So using that PYUSD as a way to take in money to hold in an account, but have that money so that the PYUSD can flow back and forth with no merchant fees. Again, that point that you made about merchants really hate having to pay those fees. So you've now gotten rid of those. And that, I think, is a big part of it.
That all makes total sense. Let's pull that apart because...
exactly. Yeah, that all makes sense, but there are a lot of details.
It's great. And I like that you started with the overall vision of where it could make sense. And now I want to sort of deconstruct it after you played that out. And I think, Disney, we'll do Disneyland, not Disney World, because Disneyland is awesome and Disney World sucks. So let's just start there as like a premise.
Okay, I will go with that.
Okay, all right, I appreciate that. And then Starbucks, obviously. I will stipulate for bank nerds listening that we are in no way saying Starbucks is a bank and that all of those Twitter threads are stupid, including the one that I posted a long time ago. So we'll just stipulate all of these things.
Thank you for that. I appreciate that.
Yeah. It's not a bank if you can only withdraw your deposits in the form of coffee. That doesn't count. So what I want to talk about with those two use cases is a couple of different elements, right? One that you laid out, and I like your framework of, what was it? Ubiquity, utility, and usability. My 3 U's. It used to be a great deck slide 10 years ago or 12 years ago. It was awesome. It was the triangle, and it had, and I would put all sorts of stuff that would fly in because I used to love doing that on PowerPoint slides. Anyone who's been a market researcher for long enough got really good and sort of proprietary about building PowerPoint slides. That's like another little thing that you have to.
And you almost felt like you had failed if you didn't have a triangle of some kind,
right?
Or the inverted triangle. You had
to have some kind of like framework that was like proprietarily yours. Yep. So we'll go off of that framework. So With stablecoins, I think probably the first one that I want to just get through, and in some ways I think we can get through it the fastest, is the user experience part,
Yeah.
right? And as you said, I think probably one of the biggest critiques I have of a lot of crypto stuff right now is that it's a pretty clunky user experience,
Oh, it's not
right?
clunky. It
And
sucks. It's
it's
terrible.
horrible.
Yeah.
Yeah, it's like
And the
it's kind of
problem
like
being on
terrifying.
crypto is it's not just hard to use, but it is if you do it wrong, you lose everything. So it's,
Right.
it's one thing to say, hey, I have a bad user experience,
Hmm.
but I can do it again and again and again until I get it right.
Yeah.
But with crypto, you don't get that opportunity. You don't have that option. You send it to the wrong address, it's gone. You send it to a non-existent address, it's gone. And
Yes.
that's where having that, and the problem has been that those of us who have been in the space long enough, I think, have become so, I guess, calloused in some way, so
Sure.
that we know how to make it work. So when we see something that's marginally better, we think, hey, that's great. But when you compare it one to one with tapping a card or any other user experience that a consumer has in paying, it's actually still terrible. But we think it's great because it's better than the terrible stuff that we had before. So that's the area where, and kind of anticipating the question on this, which is how do we make that user experience better? That's where I think, if you look at what Starbucks did, I want to say it was like January of 2010, and it was just eye opening when they came out with the original barcode. And there
Yeah.
were all sorts of reasons why they did it on their side. They wanted to bundle instead of, $5 for 5 different coffees across 5 days, which is going to cost them a set number of fees and be more expensive, bundle it into $125 reload. You've saved on all of those incremental fees. Good for them. Also, then for the consumer side, they built a really great application that I remember when people used to just buy little things so they could see the stars rattle around in the cup.
Yeah.
And I miss that,
Yeah.
That's
Yeah.
the kind of thing where if you have that experience and that application, and for the most part, the consumer doesn't even know, they're going to see their amount with a dollar sign next to it. It doesn't even necessarily have to have an S or an S bucks or anything next to it. It could be dollar denominated. They don't need to know that there is an omnibus account somewhere with all of that money being held
Right.
somewhere. So long as they know that they can go in and use the same app they've been using now for 15 years, it gets scanned by the little scanner and it is immediately recognized within their application. They're not going to care. Consumers aren't going to care. And even
Right.
on the reload, you can do it in such a way. So when you reload now, it says credit, debit, PayPal. I think there's some other options there. And if they put, do you want to buy Starbucks? The important thing for that, and this is where I think it would be key, is why would I do that? I know PayPal, I know MasterCard, I know Visa. Why would I go buy that Starbucks? And I think the opportunity there would be something like a discount, something like you would see with Target Red Card, where you get 5% off to use their card. That would be, oh, you do this, and you're a loyal Starbucks customer. So what we're going to do is we'll give you 5% off, or we will give you faster access to free drinks or whatever it is. That's the kind of place where it would be a good thing for a Starbucks or any user experience to make that not just a better experience, but also a discount or reward or something like that.
Right, right. And I'm glad you brought that up because the thing I think is interesting about honing in on this use case is it does depend on a certain relationship between the consumer and the business, right? And not
I think
everyone
so.
has this relationship, right? And so like the things I think about are, things like how frequently do I engage with this merchant, right? Like if it's once every, if it's my car insurance, provider, yeah, I just don't have like a relationship with them that's really going to sort of like allow me to like have that type of enriched loyalty driven experience. I don't really feel a particular sense of loyalty to my car insurance provider. It's very sort of pricing driven and I engage with them as infrequently as possible. Starbucks is very much the opposite in that it's like a daily part of my routine. As you pointed out, people will like go to a Starbucks and like work there all day. So the relationship that I have with them is more frequent. And then this kind of ties into the Disney example, but it's like it's more of a surrounding experience as well, right? And I think the reason that that matters so much as it relates to like what levers do we have to get you to pick this payment method versus this one, some of it is just, hey, I spend, $8 at Starbucks every single day. So getting a free drink, once I fill up all of these stars, that's going to like meaningfully matter to me. Part of it is that. But I also think the other thing with Starbucks that maybe even they didn't fully anticipate being as big a driver of the success of that program as it was is I can go in and skip all of this other shit and just get to the front of the line and get my drink and not have to go through any of this with mobile order ahead and all of that. And that is totally an advantage that Starbucks has because not only are they controlling the payment method and the app, they have control over the whole experience wrapped around me engaging with them. They can make that better or worse for me depending on it, right? This is why the co-brand cards, the credit card companies do with airlines work so well is because airlines can make your experience flying better or worse depending on how they want to shape that experience and what incentives they want to give you. Disney's the ultimate example of this.
I
Like
was
when
just
you walk
thinking,
into Disneyland,
imagine that if I buy,
yeah,
for my, I want to take my family on a once in a lifetime spring break trip to Disneyland. Again, not Disney World, but we're going to go to Disneyland. And I put, and I buy $10 worth of Mickey bucks or whatever the heck it's called, Disney dollars, over a period of time, and I have that banked. And when I go and I use those, you buy a certain amount and you don't have to wait in line. Or the way it works at Disney is you don't wait in the main line, you wait in the secondary line of people who have said we don't want to wait in the main line. So you still wait in line, but it takes off, a certain amount of time. And that's really what you're trying to do. So it doesn't have to be a 5% off. It doesn't have to be a monetary thing. But I think you're right. Is there something that you value? Well, if you're in Disney and at the end of the day, there's one more ride you want to ride. And because you've saved time on lines, you've now earned some time. That would be a good place to use it. That's the kind of thing where I think moving somebody over to or having some type of a stable coin environment or ecosystem makes the most sense. And again, I think that there are very few brands, and we could probably name them in maybe 30 seconds that are going to have that. It's going to be the Disneys. It's going to be the Starbucks, the Targets, the Walmarts, the Amazons. There aren't going to be that many that are going to be able to build that ecosystem. There are probably others out there that, might be able to cobble together an ecosystem based around maybe a lifestyle thing or a work thing or something like that, but it's going to be relatively limited. But when I say limited, if you look at the size of those companies and you look at, the massive $15 billion that a Starbucks has in prepaid liabilities because people have loaded their applications, or you look at just how many people go to a Disney property around the world, is it going to compete with ACH? Is it going to get rid of Visa and MasterCard? No. But is it going to still have a sizable number of retail applications? Yes, I think so.
Yeah, no, I think that's right. And I think that, again, like you have to compare it to what already exists in the market, right? And I think, like, let's just use credit cards as kind of like the boogeyman, because a lot of times that's sort of how this debate is framed. You have to kind of think about it from the consumer's perspective, right? Credit cards as a generic mechanism for rewarding me as a consumer for spending money are actually very good most of the time, right? Because most of the places I spend money, I'm going to get more value out of getting rewards funded by that 2 to 3% based on shopping there than I would out of whatever little loyalty ecosystem that individual merchant would be able to construct. And that could be because I don't interact with them very often. It could be because just the nature of the relationship I have with them is different. It could be because they can't construct this like integrated experience that's that much better. But, and you see this today with other forms of payment, there are a category of merchants that have this special relationship we've been talking about that already do something other than just the standard we pay 2 to 3% to accept credit cards and just let the loyalty walk out the door. And this is airlines, this is Walmart, this is Target, this is Starbucks, right? And so essentially what we're saying is if you're the type of merchant that has already built the relationship and the ecosystem that allows you to construct your own loyalty infrastructure and get consumers to use it en masse, stablecoins would be another thing you could get them to use instead of cards because you're already driving that behavior. So that sort of covers off on user experience and consumer adoption. let's talk about utility and ubiquity. And I wanted to use both of your other U's together because I actually think in some ways for stablecoins, they are connected as one of the kind of core reasons here. So obviously, as we've been talking about, a big motivation for businesses in doing this is to save money, right, on payment processing costs. And that is a motivation that I think I've always had this sort of mental model, which is like the larger the business, the more likely they are to have like corporate finance and treasury management teams. And those teams just get to sit in an office all day and just get pissed every day at the amount of money they're paying in payment processing costs and just obsess over like, how do we optimize this down? Like, I just hate this. And, on the other end of the spectrum, if you're a small business, you're just trying to stay alive. You're trying to attract customers. You're trying to do all these things. The 2 to 3% probably annoys you, but it's way down the list of things that you care about. So when we think about that, obviously, you can try to optimize down the payment processing costs that you're paying. But as we've talked about, there are a number of ways to do that, right? If you offer your own card, we'll just use Costco, right, and their deal with Visa and with Citi for the Costco card, which is tied to membership and all these other things. They essentially wipe out their payment processing costs by doing that because they've essentially sort of built their own little payment infrastructure with Visa and with Citi that allows them to optimize their costs of accepting credit down very, very, very low. The same thing exists with Starbucks and prepaid, right? The beauty of this is if we can have someone load up their prepaid account, then either we are saving the payment processing costs of just having them load one large amount and pay 2 to 3% of a much larger sort of single transaction to load up his account, or if we can get them to do it pay by bank style with ACH, we're not even paying that and we're just realizing that benefit. So all of these other forms of sort of hacking around the card networks and that 2 to 3%, a lot of them have already been tried and realized this benefit. But I want to go back to a thing you said before. You touched on a thing that's really important with, we'll just use Starbucks and the prepaid model as the example. This idea of something being an asset on a balance sheet rather than a liability. Can you double click into that?
Yeah, if you buy a prepaid card, and prepaid world, within payments, there are so many different niches and different ways that we pay and different levels of expertise and products. Prepaid gift card is one of those areas that I find absolutely fascinating because it's really, really important. And there are so few people who really know all of the ins and outs.
You can count them on like one hand.
Yeah, the accounting, the breakage, escheatment. What do you do here? How does this work? How do you, there are so many things. But one of the things about prepaid or a gift card is if I buy a gift card and I give you $20, that's not an asset. It's actually a liability. That's how you have
it's to money I owe you.
Yeah, that's
right.
Or
in the case of a retailer, it's
right. You owe me coffee or a cake pop. That I get that from you. You can't say, "Oh, well, I forgot about that." We'll just pretend that I didn't really take that money. No, you got to give me something at some point.
Right.
So it's a liability. Now, this I think is a really important thing, though, and we can get into some of the, and I'm sure we'll probably want to talk about some of the regulatory treatment and accounting treatment of stablecoins. That's all still TBD. A lot of this is stuff that there really is no generally accepted way of looking at stablecoins just yet. So there are things that could change. But at this point, if I give you money, I'm buying that stablecoin. I've now bought a stablecoin, so it's an asset as opposed to I've given you money.
And hang on one sec, because I want to back up just one half step on the liability front, just to sort of illustrate for people how this works. And you mentioned some of the words, but I want to make sure people know what they mean. So I load up my Starbucks sort of prepaid account, even though, as you said before, it's not really presented to me as a prepaid account. These are just dollars in my little Starbucks account that I can use to redeem for coffee. There are two, I think, really important concepts that tie to the treatment as a liability. One is, you mentioned breakage, right? And the basic idea from an accounting rules perspective is you are not allowed to consider the money that someone has sitting on a Starbucks gift card as money that you can just use fungibly for other purposes until certain conditions are met over a period of time, right? Because eventually, and we've all had this experience with physical gift cards, if I have $2 sitting on a Target gift card and it's somewhere sitting in my sock drawer, I'm never going to spend that. And there is an accounting treatment called breakage that allows target to realize that revenue sitting on that card that someone is very unlikely to use, that you eventually get to benefit from. And the reason that matters is if you're a significantly large enough retailer or purveyor of coffee, and you're getting tons of prepaid volume, that breakage amount can be very valuable to you over time,
Correct.
but it's limited and you don't get it right away. And you have to be very careful in the way you do accounting treatments on it. By the same token, the other process that happens at the end of a lifespan of these types of accounts is escheatment, which is a legal process for essentially dealing with unclaimed property that hasn't been interacted with. So if I have an account, and this exists in prepaid deposits, a number of different places, if I have money sitting in an account and I haven't touched it or done anything with it, at some point there is a legal process that you go through, and it's defined on a state by state level for when that property can be considered unclaimed property, and then the escheatment process of, in most cases with the states, handing it over to the states, right? And again, it's a very complex accounting process. There's a whole process you go through to try to notify the consumer and to reach out to them before it's considered to be unclaimed property. And so both of those processes are like very well defined, very like well challenged from a legal perspective, and well tested accounting processes for dealing with liabilities and the sort of potential end states of those liabilities that sit on these companies' balance sheets.
Right, because it can't go on forever. That was a fantastic definition of both of those. The thing is, it also is, as you mentioned, state by state. There are a whole lot of different things that a company like a Starbucks who operates in 50 states needs to know. There are a whole lot of specialists within those companies that are probably just legal experts across both of those areas. And so I am not saying that what's going to happen is you turn that all into stablecoin and all of those problems go away. What I'm saying is all of that stuff is still to be worked out. And that is going to be a very interesting process. Likely it will be, you have an account, you've sold the stablecoin are going to have to be matched 1-for-1. That is going to also be one of those things that we have to figure out in terms of who can issue a stablecoin. Is it going to be through an insured depository institution, or is it going to be a payment provider who has some sort of license that can do that? How are they going to have to be able to set that up? Is it going to have to be you have an account of very liquid assets, treasuries or cash or something like that? What can you do with all of that? All of that stuff still needs to be worked out. We don't even have necessarily the legal framework, much less the regulatory framework, because there's a stablecoin bill being looked at right now that would take care of some of that stuff.
But the theory,
right?
Just to bring you back to where you were before I interrupted you before, the theory, assuming everything you just said like gets worked out and there's like a framework that makes sense, the theory is that because stable coins are a more, and this ties back to your use, because they can be a more ubiquitous form of currency beyond just one use case, walking into a retailer, walking out with goods they sell, because it can be that, and because there can be extra liquidity from the market sort of pumped into these stable coins, that potentially would allow them to be treated as an asset rather than a liability. So I want you to
treat it as an asset. So that's going to be a little bit different on what you're going to be able to do just from a value standpoint, you being a company. So it's going to be, it will operate a little differently in terms of what a treasurer can do with the monies. It's going to operate a little bit differently in terms of how the market is going to view that asset on your books. So I think that's going to be an interesting part of this. And I think that that will be, again, all of that stuff is still to be determined. But when you look at it compared to some of the stuff that you have to deal with from a prepaid and a gift card standpoint, or just a prepaid account like what Starbucks or anybody else does, does it solve some of those problems? And that goes back to the whole utility thing. Utility has to be on both the consumer and the merchant side. I mean, merchants care about two things. Is this going to lower my cost? Is this going to increase my sales? Really pretty much all they care about. And so if they're looking at it from a cost standpoint, it's going to lower your cost if you're now eliminating not just like a Starbucks gift card where you're bundling a reload. So you're eliminating 9 of those 10 fixed costs. So instead of 10 cups of coffee, you only buy 1 reload that covers 10 of those. So you've now saved that. It's not just that you're saving on, but you're now getting rid of, once somebody has bought it, you've gotten rid of all merchant costs across basically all of those purchases, because now you've got that money that cash is sitting somewhere. And so you've eliminated even more of those costs. So you've lowered your costs. You've probably lowered some of your, I would think, and again, this is something that it's gonna be in the details as this begins to mature. You've eliminated a lot of those costs to just manage that. Now, there will probably be management issues as well on a stable coin, but that is that utility discussion. You've now made it a much better from a management and from a merchant standpoint. You've made it a better process by which you're holding onto this money, basically pre-funding all of the purchases of coffees and cake pops. And then on the consumer side, again, the utility there is loyalty and rewards is really probably, or discounts or something like that, or like we were just talking
it's the
about,
mechanisms we already know
right,
that they use to drive this behavior.
right. So, and probably you're going to find people, oh, well, if I can do that, one of the things that you find with places like Target, from a loyalty standpoint, people like using their red card, getting 5% off. So they spend more. I know, just personally anecdotal, I spend a lot more at a Target when I am there thinking, well, I'm getting 5% off. So while I'm here, buying groceries,
100%.
I might as well go ahead and throw in a couple of other things that I know I'm going to need. I don't think I've ever walked out of a Target without buying socks. I don't know why. But
right. Well, I mean, they
everybody has
disappear,
that thing
and
they throw into their basket. While I'm at Target, I might as well go ahead and throw this in there. Mine happens to be socks. But that's again increasing that basket size. So, that's the part where, from a utility standpoint, you could see again, depending upon how all of these things begin to work out, an incremental gain in that utility, which is what you really want over existing payment mechanisms.
Yeah, no, that makes sense. And the prepaid example is so instructive, right? Because again, the thing I always come back to with this stuff is the sort of unsophisticated version of this conversation is, well, like, oh, well, stable coins are cheaper than credit cards, so ergo we're going to use this. And it's like, no. We already have other things that we
that are cheaper,
do,
right?
That are cheaper, that undercut credit cards. And if you're sufficiently big and sophisticated like a Starbucks, you've already figured this out. Like, the game is already like well established. There are rules for doing it. So the question is, why stablecoins? It's not why stablecoins over credit cards. That's obvious. The question is, why stablecoins over prepaid? Why stablecoins over pay by bank? And so I love this conversation about the prepaid, the thing people don't appreciate from a complexity perspective, and really from like an operating capital perspective, is it. They are very annoying to deal with. And Starbucks would be much less annoyed and much more free to use this money in flexible ways to create value for itself and its customers and its suppliers and all these other things if, theoretically, and again, lots of rules to be worked out, you could use stablecoins in place of prepaid to function in this same ecosystem that they've already built. And I touched on something there that I want to circle back to, because the other thing you mentioned when you were painting your vision of the future, which I just loved, is this idea, and this kind of gets us to the third U, ubiquity, how stable coins in this model can function in a broader way or a more sort of fungible way than existing prepaid structures that are designed for very specific use cases. And so I think the example you mentioned, and we'll just use Starbucks here, but obviously Disney, you could easily imagine how this would work in Disneyland as well, is Starbucks is an ecosystem, right? And the most clear expression of that ecosystem is barista at the counter, customer on the other side of the counter, getting coffee, exchange of value. But there are many other exchanges of value that happen within the larger Starbucks ecosystem. They happen between customers buying other products while sitting on their computer typing while sitting inside of a Starbucks. They exist between Starbucks and its suppliers. They exist between those suppliers interacting with each other. There's all kinds of other parts of the Starbucks ecosystem. And I would hazard a guess, I don't know this for sure, but I would hazard a guess that the infrastructure they've built for prepaid Starbucks account, that whole thing, is pretty narrowly tailored to this one use case that they've really solved for. It's kind of difficult to expand it to cover other ones. So can you talk about sort of the role that stablecoins could play from a ubiquity perspective within the entirety of these retailer ecosystems rather than just the one use case that they design it for.
Yeah, no, that's a great example of, you take if you go into Staples and you say, hey, I want to pay, and you pull out your Starbucks app and you say, I want to pay with this, they're going to say, we're not Starbucks. We don't want to do that.
Right.
But if
Sir, this is a Wendy's. Yeah.
they're going to say, yeah. But if, again, take a small business person who uses a Starbucks, local Starbucks to work, have meetings, do all of that kind of stuff, and they're using Starbucks often buying coffee, and they put that money into an account. Remember, that account now, if it's done the right way, and the way we think that these stable coins are going to be built out is there will be a cash or a cash-like, very liquid asset backing that Starbuck. So it will be fungible in the sense of, that a dollar and a Starbuck are equal. Therefore, if somebody were to take that, some other company were to accept that, they know that they could exchange it one for one with a dollar, if they so choose, at any point. So the idea of being able to take it, knowing that there's a stable coin out there, or that there's a dollar out there, wouldn't necessarily be a risk. There's no issue with that. That would be where you could see them saying to a partner like a Staples, hey, Staples, you're right next door. Or heck, if it's Target, you may have a Starbucks in the Target. But that this is going to be something that you can collect from us at any time. Why won't why don't you accept that? And if you accept that from our customer at no cost to you, you can exchange it for free anytime you want. You've now, again, saved on that merchant fee that you would normally have to pay if they walked over from the Starbucks and said, here is if they're not using a red card, here is my credit card that I want to pay with. That would be a way where you could build that ecosystem. You could think about other places where, Amazon seems to be one where I would think that would be, all of the merchants on the Amazon marketplace would say, yeah, we will accept that because we know that we're going to be able to exchange that anytime. One of the things that PayPal just announced at their Investor Day a couple of weeks ago was merchants can now pay their vendors with the PayPal USD. So again, you created that ecosystem because they own both sides of the relationship. That would be the difference, is so long as that Starbucks or Amazon dollar or whatever it is matched by a liquid asset, a dollar, cash, something in an account, and you can exchange it at any point, then you'll just hold on to it. You can use it, and so long as you're using it, you're not paying any merchant fees. And then at some point, if you need to, you can go exchange it and get your money for it. Or you just hold on to it. It's going to be an asset and it's not going to be going away anytime soon. Again, that does argue towards you want to make sure that this is a very large retailer or a very large partner that's not going to disappear. You want to make sure that that's something that you're going to be able to access at any point. But that's where I think you see that ubiquity is you now build out those ecosystems, and that stable coin just becomes the coin of that realm, the thing that is used within that ecosystem. One of the things I will say is a lot of details to make that all acceptable at points of sale through those partners. And so it's going to argue towards only those companies that really do have that large vendor partner network where they would be able to build that.
Yeah, no, I mean, and coin of the realm is a pretty good sort of mental model to build off of, I think, for that, because again, sort of if you keep in your head this picture of like Visa and MasterCard as this like network of all of these different nodes, what we're kind of saying is that one of the big nodes in that network is Starbucks. And not only is Starbucks a really big node in that network, but there's a bunch of smaller nodes that sort of orbit Starbucks, right? And have like interrelationships with Starbucks or with Starbucks' customers. And so the theory of the case is that you could apply stablecoins as sort of a fungible value transfer mechanism to allow you to kind of like ring fence your little part of that larger network, right? And say, within this, here is an alternate way to transact. We are big enough as Starbucks or Amazon or Disney to sort of guarantee comfort and compliance and liquidity and all of the things that would go into like being nervous about trusting something like that. But yeah, I mean, I like the Amazon example. Like if you're an Amazon merchant, you are already highly dependent on and have sort of made a bet that Amazon is going to be infrastructure you can build on and sort of trust your livelihood to. It's not that much of a stretch to say, oh, okay, we'll use this other Amazon mechanism to pay other suppliers or to get paid, like that makes sense. I guess a question that occurs to me, and you sort of hinted at it with the PayPal announcement, is it seems like there's one side of this sort of network building process or problem, which is, hey, we need to be able to sort of guarantee to a large network of suppliers and buyers that they should feel comfortable transacting in this world. And someone like a PayPal would be very well positioned to do that because they already do that today. They connect merchants, they connect consumers. There's like a two-sided network that already exists there. So if they say, hey, we have this new thing that allows you to do that, then all of the participants in that ecosystem would sort of naturally get that and trust that. And whereas if you're like a Starbucks, as we were just talking about, and you want to go to Staples and say, hey, you should add this to your point of sale system and it's going to be great. And a lot of your customers also shop at Starbucks and are going to be loading that up. That's a theoretically very possible case to make, but it's a harder case to make because Staples is going to be like, okay, what the hell? Like, I don't know that I really like want to do this. Can we really trust this? So like, that seems like a bigger leap there. However, the flip side to the network building problem is, I think at least, Starbucks has a much greater lever to pull. In fact, they've already done it to drive that consumer adoption and get that side of the network sort of spinning. And so if we think about this two-sided network challenge to building this liquidity and this ubiquity, the consumer side would seem to benefit from brands that have a very strong value proposition they've already built with consumers that allows them to steer consumer choice. And so that would be Target, that would be Starbucks, that would be Disney. On the other end of the spectrum, you have these sort of network providers that probably have a much stronger ability to drive merchant adoption because they already function somewhat as a network for merchants to drive payments. So they can drive that sort of ubiquity on the merchant side. But I think the concern I would have is, can PayPal really get a lot of consumers using Venmo and using PayPal to adopt this? Can Amazon get a lot of its shoppers, because it has done a little less work driving sort of adoption of consumer payments than a Target or a Starbucks has? Can they drive that side of it? So do you have a sense of, on the consumer side versus the merchant side, like where these things might be more likely to kind of take root and succeed? Which network building problem do you sort of subscribe to being more solvable?
I think, I think a lot of it is going to, that ubiquity issue is going to be as much a function of the user experience and the utility. So am I getting something out of it? Do I then look for the places where I can then earn that? And that happens, that you go back to, am I getting any offers from my American Express? Okay, I'm going to go look for opportunities to get that offer. And I think this is sort of the same thing, which is there some benefit? Therefore, I will now go look for that. And I do think that a network like a PayPal that can offer to merchants fee-free payments. There's no, to accept a PayPal USD, there's no cost. Therefore, you can pass that along, or we can provide, couponing within the application so that if you use this, you get something off. Those are the types of things where I think that network can work with all the different players that aren't big enough to create their own.
Right.
The other side, and that's going to be, I think, the key, is they're going to have to say, as PayPal, yes, we want to build this out. We are going to make it available to everybody. Here are the benefits to you. Let's now have discounts within, and they put discounts within the application all the time. That's the kind of thing I think that they would be able to do. On the other side, where you do have the big brands that can do that, again, I always look at the success of the Target Red Card. I don't even know what the percentage is now, but I think it is a pretty large percentage of purchases that are made on the Red Card. I think it's something approaching like 25%. Correct me if I'm wrong, but I think that's a sizable number. And so if you look at a brand like that who could say, we're going to give you 5% off on all of the things that you buy here. Obviously there will be the caveats. You can't use it with Apple products. You can't use it with, they've got that list. But if you can say, hey, we're going to create some real benefit to you as a consumer, and the merchant side is, if you're a partner of ours, you don't pay any merchant fees because you want to stay within the ecosystem. I think that you have the ability to create that ecosystem, because almost a sense of, yes, there would be some development costs. Yes, there would be some back end stuff that would have to be done to ensure that payment and settlement happens. But from a partner standpoint, there's really no downside to accepting. If you have a large enough brand as a partner, there's no downside. Somebody brings it to you. Again, the stablecoin is you can exchange it for $1 anytime you want, so you know that it is $1. There's not that much of a downside other than, and I don't want to just wave away, oh, sure, there
No,
is going to
sure.
be just a little bit of, that there's a lot. There will be a lot that will
Yeah.
have to be done to make that work. But if you know that you're holding those people within that ecosystem, and if they stay within that ecosystem, you benefit. And I think it would be a smart way for a brand like that to say, you will be the only office supply or provider that we're going to have in, or something like that. I think those are the types of things that it would have to be put together smartly. But if you're one of those big brands, the chances are you really understand how to put those things together smartly anyway. Again, if you're a Disney, you know these things. This is core to who you are, is how do you do a really good user experience. So I think none of this is going to happen overnight. I will put that out
No,
there
of
right away.
course.
This is going
Yeah.
to be one of those things that evolves over time. Um,
hmm
One of the things I have seen recently is, as you said at the very beginning, stablecoins are a hot topic. And so you get this idea that stablecoins are going to happen by the end of the year. Everybody's going to have a stablecoin. No, we are talking about something that's going to take some time. And I think that seeing those ecosystems build out over time is going to, we're looking at, it's going to happen sort of slowly and then all at once. That's the way it's probably going to be built out. But I think that's a really good way of looking at it, is for those who can't do it themselves, they will participate in an ecosystem like something like a PayPal, or if you have a large brand, you will probably have maybe your own.
That split makes sense to me as well, because it kind of describes like why you would go one route versus the other. And I think it's also really important to understand that like the size of the market allows, I think, for both to
I think
exist and for
so.
both to
Yeah.
exist in probably in multiple ones, right? I mean, like I could certainly see a PayPal, obviously stablecoin, which already exists, and PayPal's down the road of doing that. Living next to a Starbucks one that occasionally brushes up against it, living next to an Amazon one that occasionally brushes up against it. Like it's not, again, we already see this in a non-stablecoin version of this world. Like a lot of this infrastructure exists and the market is big enough to support it. I do think one of the things that's probably most likely to be kind of an interesting tell on this is not every company is going to have the sort of long-term vision and stomach to build this out, right? And that's
And they
why,
may
like,
not need to. I mean, that's the whole
well,
thing
that's
is,
the interesting thing. Yeah.
right. And I do think that, it would be a very, back to the idea that skepticism is healthy, it would be a very healthy skeptical thing for somebody to say, Starbucks is doing just great on its own. Why would we need to do all of this, you know, this running around trying to create a stablecoin? And I think that is a wise reaction. And I think there is going to be a lot that is going to have to work for anybody to say, we're going to do this. But I do think that the existing infrastructure, the existing ways that we are working with, especially prepaid and gift card and other things, I think that to me says, yes, there are going to be places where we're not replacing ACH, we're not replacing Visa, we're not replacing checks, we're not replacing any of that. But there are some real opportunities where stablecoins on the retail level are going to make a whole lot of sense. Domestic.
Yeah, domestically. I completely agree. And I'll just flag two last things and then I'll let you go, James, because this has been awesome. One is I do think the growth of like domestic use cases, growth of some of these new like ways of thinking about how you can apply stablecoins, it ripples back through the stablecoin ecosystem from a competitive perspective in an
Mm-hmm.
interesting way to me too. Because like one of the things I've been shocked to learn in my sort of ongoing campaign to educate myself about stablecoins is sort of the competition that exists between like the tethers of the world versus like a Paxos or a Circle. And the thing I think that's interesting there is just that there's a there's a demand for certain models of how to deliver stablecoins depending on the requirements downstream for the use cases, right? And if one of the requirements for this use case we've been talking about is, look, I have to know that this is backed one-to-one by dollars, that it's really well supervised and audited, and like all of these things that would make adoption of it for this use case critical, well, that's going to preference one type of building and issuing a stablecoin versus another model, right? So like regulation and those things will, I think, ripple back through that. The other thing I just want to flag is like, maybe we can talk about this next time I have you come on. The impact of all of this on banks is pretty interesting to me as well, because a lot of payments infrastructure is sort of built on the assumption that we're going to be drawing these payments from deposits that are sitting in bank accounts. And the Starbucks example is probably the only real large scale one where people are keeping a balance of something in a recurring fashion somewhere other than a bank. But it's not that hard, whether it's prepaid. Well, that's the question. That's the question.
Now we move back out of the retail side. Now we've got all of this commercial, because it has to sit somewhere. All of that money is in a bank. So does a bank look at this and say, we lose that, but we now get $15 billion in an account with a huge retailer that we are holding on to. And really,
are those deposits brokered? Are those deposits sticky? Like it gets into all of these like bank nerd questions.
That becomes the whole discussion on. It's really great for me to spin out all of these what ifs for an hour with you, but there's a whole lot that's going to have to sit underneath it that we still have to figure out. And that's where banks, when people say every bank is going to have to know what their stablecoin strategy is going forward, it's easy to hear that and think, why would banks issue stablecoins? That may not be what we're talking about. We're talking about, how do you treat stablecoins as a partnership, as a product? What do you do with deposits? What does that mean
from
a treasury standpoint? That's a commercial product you're now selling. There are a lot of things that are going to change. And that's the part where, again, it's really easy for me in an hour to say these are the great things that Disney or Starbucks or Amazon can do. There are a lot of details that need to be worked out. So that's why I think it's going to take us some time.
Yeah, no, I very much agree. All right, James, we did it. That was an hour of like nuanced, honest conversation about stablecoins. I am just thrilled with getting to learn a little bit more about this from you. As always, I really appreciate the work you do in this space and the nuance that you do it with. We'll have you back.
Thanks for having me on.
All right, I appreciate you, sir.
Take care.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.